Hi, everyone. I'm Jerry Davidsey, CEO of Presilium Private Wealth. Welcome to Financial Planning Fridays, our weekly video series on financial planning, where we work to simplify wealth management decision-making for our clients so they can focus on what is most important to them. Today, in our 12th episode, we wanted to talk with you about how important it is to stick with the investment strategy that is part of your long-term financial plan through both up and down markets, as well as share data that supports this thinking. There is a popular saying in personal finance that says, time in the market matters more than market timing. We wanted to take a close look at the data and see exactly what this means for our clients. The market has consistently moved higher over time. In fact, it is positive about 53% of the time each day, 63% of the time each month, and has been positive 73% of calendar years. Let me show you the data from the past 42 years. This chart from Fidelity shows a $10,000 investment in the S&P 500 from 1980 until June 2022. If you had kept the $10,000 invested the entire time and ignored it, your investment would have grown to just over $1 million. If you missed just the 5 best days over that 42 years, moving out of the market due to temporary bad news, your investment would have been worth $350,000 less, costing you over 1/3 of your return. You can see if you missed the 10 best days, your investments would have missed half of the return, or more than $500,000. And finally, if you missed just the 50 best days of more than 10,000 trading days over 42 years, less than 0.5% of all days during this time period, you would have missed more than 90% of the return, more than $900,000. To provide additional context with a very recent example, in 2020, during the COVID pandemic, Americans moved an enormous amount of money out of long-term stock funds and ETFs, greatly surpassing even those levels seen during the global financial crisis. Unfortunately, funds did not begin coming back in until the market felt much safer. Why this matters is that on March 23rd, 2020, we saw the market low of the COVID-19 pandemic. On March 30th, just 1 week later, the market was 17.4% higher, and on April 14th, 2 weeks after that, the market was 27.2% higher than it was on March 23rd. Many of the largest market gains come soon after a market low. Now is an especially good time to look at the historical outcome of making investments during bad times. This chart shows how investing during a recession has worked out over a 70-year time period from 1949 to 2019. If you were brave enough to make an investment during a recession, it would have averaged 18.4% just 1 year later, and between 12 and 13% per year over the following 3 to 10 years. The green bars are those investments made during a recession, and the blue bars are investments made during the good periods instead. While both sets of returns are good, it is clear from this data that investing during recessions has led to much more upside. We can't be sure what will happen in the future. However, if we use history as a guide, we can draw 2 conclusions. First, time in the market has been much more important than market timing. We need to make sure that we remain invested so that we can participate in the best days, which have previously made up a huge percentage of the returns. Second, investments made during recessions, those made when things often feel at their bleakest, have performed better after 1, 3, 5, and 10 years than investments made during growth periods. A special thank you to our client, subscriber, and great friend, Bob B., who suggested that we create a video on this topic. Our goal is to create content that addresses the topics most important to our clients. So if you have a topic that you are interested in or would like to learn more about, please let us know. Thank you for joining us today. Have a wonderful weekend.